Yesterday, the Federal Reserve voted to raise interest rates for the seventh time since the end of 2015. Fed Chairman Jerome Powell issued a press conference and he tried to encourage everybody and said, hey, look, the reason that we are doing this is because the economy is doing great and we're just trying to control inflation a little bit. He mentioned that the true consumer inflation has not picked up, but he did hint that because of the tightness in the employment market, we're looking at numbers that show that the people looking for jobs are less than the number of jobs open. In other words, it's going to cost employers a lot more money. That could lead to inflation and things overheating. And nobody wants to see runaway inflation. And so that's what the Federal Reserve is trying to control. One thing he didn't really mention was what we've seen in the manufacturing prices paid index. And as you can see from this chart, it is sitting at levels that typically are characteristic of the late stages of an economic cycle. For whatever reason, in the very late stages, we see manufacturing prices just explode to the upside, and that's what we're seeing now. Now, that can lead to two concerns. One, manufacturers can choose to pass those higher prices on to the end consumer. That can hurt their sales a little bit. It can also lead to inflation on the consumer side, which we really haven't seen yet. Or the manufacturers can choose to not pass it on, take some margins that are already tight and make them even tighter, which again hurts earnings. And so that's something that I think we need to watch closely. But back to the Federal Reserve. I looked back, and since 1960, we've had 9 recessions. And that's shown by the gray bars on this chart. This is a chart of the Federal Reserve's effective funds rate, which is the policy that the Federal Reserve sets. That's the short-term interest rates, and then that can play an impact on a lot of things like credit cards, your bank loans, and other things to that matter that can slow things down. But as you can see, every time just before we hit that gray bar, the Federal Reserve is doing the same thing they're doing now, which is raising interest rates. Now, the problem with the Fed, everybody thinks they have this nice big crystal ball. They have all this data out there that can help them predict things. One interest rate change on average takes 9 to 12 months to filter back down through the rest of the economy. So what that means is the Federal Reserve is acting on data based on interest rate changes sometime from last March to last June. Sorry, last June to last September. We don't know what the impact of the December rate hike has even had on the economy yet. And so they're dealing with really old data and trying to make projections. The Fed chairman in his press conference tried to calm everybody and say this is normal, things are great, we're not going to go too far. But I have a strong memory of Ben Bernanke telling everybody that would listen back in 2008 that things would be contained. You go back to Alan Greenspan. He had no idea the recession was coming, even though he was one that warned that things were getting overheated on the valuation side. He just didn't see it coming. And so that's something we have to be really concerned about is, once again, if history is any guide, which I believe it is, the Federal Reserve will go too far. They'll throw us into a recession. Now, that doesn't mean panic, run to the exits right now. What we're doing at SCM is what we've always done. At this stage in the economic cycle, risks have definitely gotten higher. The market is getting more volatile. That's usually a sign of a late stage rally, late stage bull market that we need to definitely be cautious. We've taken some money off the table, but we're still in. Our economic models, similar to the Fed, say things are doing pretty well. The problem is we do have some indicators that are creeping down to an area that within the next 12, 18 months, we could be looking at a recession. And one reason we're always concerned about a recession when it comes to investing is we typically see just before and during a recessionary bear market, the stock market can lose about half its value on average. It's sometimes somewhere the lowest, 35% up to 55, 60% during that phase of the economic cycle. So definitely something you don't want to do. On the bond side, these interest rate changes are making it a little bit harder to make money, but what we've always seen, late stages, we just want to conserve capital as much as we can and wait for the opportunities that will be coming on the other side. So be careful who you're listening to. I respect the Fed chairman, but you need to definitely be cautious with this latest change in interest rates.